It's been said that the three pillars of finance are assets, liabilities, and equity. But what do they mean and how do they relate to each other? What are the fundamentals that go into business finance? How can you grow your business and make more money through financing? In this video, we'll explore the three pillars of finance in detail and give you advice on how to put it all into practice when it comes to your own company. Assets. Cash flow is a term used for how much money is generated by your business. Assets are what you have or need to run your business, from land, buildings, equipment, and inventory. And finally, there's financial management. What financial assets do you need? Are they available? What is their cost? Is there a market for them? Can they be acquired now, or should they be purchased later when cash flow improves? Will future capital needs best be met with long-term debt, that is, loans, or short-term debt, that is, credit cards? Liability. When it comes to financial management, you want your liabilities, or outstanding debts, to be as low as possible. Your liabilities are likely just a number on a balance sheet. You're not thinking about how that debt is affecting your business's cash flow. Here's an example of how debt can hurt your business. Let's say you have a $1 million debt over 10 years. At an interest rate of 5%, and after paying $250,000 in interest, that remaining $750,000 will have doubled in value due to compounding. To put it another way, every dollar that is not used for long-term growth is simply taken away from you. Equity. To build a solid financial foundation, you need three pillars that all relate to one another. The first is equity, or how much you own versus how much your creditors own. To put it another way, equity means at risk. For example, if you borrow $50,000 from a bank for an operating loan, then your equity will be 20%, $10,000. If your business is profitable and growing steadily but doesn't experience any major disruptions or setbacks, there's no reason for alarm. Equity is an important component of financial management because it puts you in control by keeping all at-risk investments under your ownership umbrella. You always have complete ownership over these funds as well as full control over what happens with them. Growing your business. The best way to grow your business is by moving products or services through additional channels, such as selling into new markets, selling more units in existing markets, or increasing your average sale amount. There are three different growth strategies you can pursue: vertical growth, horizontal growth, and market penetration. The following sections discuss each of these three strategies individually. Vertical growth. Business owners need to get bigger, but they can't get too big too fast. Vertical growth refers to growing a business within its core competencies while not overextending its reach or capabilities. This growth strategy helps businesses run more efficiently, be more profitable, and avoid costly mistakes. One way to measure vertical growth is by looking at your gross profit margin, GPM. A higher GPM means you are selling products for higher prices, and that could mean you are doing better in terms of profitability. The average GPM for companies in North America is about 38%. For retailers, it's about 30%. For manufacturing companies, it's about 25%. And for technology companies, it's over 60%. Horizontal growth. Horizontal growth is about expanding your business into other services or industries, for example, by acquiring a new business or developing additional services that complement your existing offerings. One of many examples of horizontal growth can be seen in Kodak. In its early days, Kodak was a camera manufacturer. As it grew, it expanded into film development, photo processing labs, and even digital cameras, all while keeping its name in front of consumers as they switched from cameras to digital photography. Assets are everything else that belongs to your company. They include both physical items, like equipment, and intangible ones, like patents. Assets allow you to build on top of past successes while minimizing risk going forward. For example, if your business grows so quickly that you need more office space, you might buy an additional building instead of renting one. Market penetration. The first step for any business is getting your product or service in front of customers. There are a few different strategies for penetrating markets, but all companies focus on three core pillars of finance: revenue, expenses, and assets. Below are some key points about each of these areas. Revenue is how much money you make from selling your products or services. It's important to remember that revenue can be made in two ways, by selling more products or by raising prices. You can also increase revenue by creating new channels for sales, such as increasing customer traffic via social media marketing campaigns. Expenses are what it costs you to operate your business, including salaries, rent/mortgage payments, utilities bills, etc. When operating a company with no revenues, that is, before making a sale, it's important not to spend more than you make, otherwise, you'll go into debt right away. Thanks for tuning into It's Finance, and thanks to all our viewers out there. Don't forget to like and subscribe for our content on finance, businesses, and other topics here on this channel.